Okay, let's unpack this. We're diving into the latest on General Mills' first quarter receipts. Uh, Seems like a company navigating some really interesting strategic currents right now.
It really is. What's, fascinating here is that while the headline numbers might suggest some challenges, there's definitely a strategic narrative unfolding.
Right.
It's about understanding not just the immediate performance, but the calculated moves General Mills is making for their long-term vision. It's a competitive space, after all.
So let's start with that big picture then. General Mills, we're talking Cheerios, Pillsbury, huge brands, just wrapped its first fiscal quarter. What did that tell us? How did it stack up?
Well, the headline showed fiscal Q1 sales fell 7% to $4.52 billion. Now, that was pretty much in line with what Wall Street was expecting, actually.
Yeah, so no big surprises there initially.
Not on the top line, no. But breaking it down, reported sales were down 7%, yes. But if you look at organic sales, stripping out divestitures and things like that, they declined by 3%.
Still a decline.
Still a decline, exactly. And that dip hit their profitability, too. Adjusted operating profit declined a pretty substantial 18%, and adjusted EPS, that's earnings per share, fell 20%.
20%. Oof.
Yeah. Now, this is where it gets interesting, because despite those declines, they actually reaffirmed their full-year FY26 outlook.
They did, even with those Q1 numbers.
They did. They're still targeting flat to slightly positive organic sales, so like -1% to +1%. But, and this is the key part, they still expect operating profit and EPS to be down 10 to 15% for the full year.
Okay, here's where it gets really interesting for me. Management explicitly called FY26 an investment year. We hear that phrase, but what does it truly mean for General Mills and for you watching this space? Sounds like they're playing a longer game.
Precisely. Yeah, that investment year isn't just corporate speak. It's a deliberate strategic pivot. General Mills is focusing hard on restoring volume-driven growth.
So getting more actual products sold.
Exactly. Getting more products into more shopping carts. And they plan to do this through, well, a few things. Significant innovation. Strategic pricing resets, being competitive, basically, and strong marketing campaigns to sort of re-energize their core brands.
Makes sense.
So if you connect that to the bigger picture, it suggests they're making calculated moves right now, impacting near-term financials, yes, but because they believe these investments are critical for a stronger market position down the line. It's that classic trade-off.
Short-term pain for long-term gain, maybe?
That's the idea.
Okay, that strategic framing helps. But, an 18% drop in operating profit isn't trivial. So moving beyond the headlines, what do the detailed financials really tell us about what's going on under the hood this quarter? Let's get into those specifics.
Absolutely. Let's dive deeper. So net sales, as we said, $4.5 billion, down 7% year over year. Now, 4 points of that drop came from divestitures, selling off businesses like their yogurt brands.
Right. They sold off Yoplait and others.
Exactly. And the other 3 points represented that organic decline from their ongoing businesses. Organic volume, the actual amount of stuff sold, was down 1%. Interestingly, part of that was apparently due to shipment timing in their pet segment.
Okay, a little operational quirk there.
Yeah, detailed to note. And their organic price mix was down 2%. This is telling because it reflects specific price investments. Think targeted promotions, maybe some price reductions, increased spending with retailers.
Trying to drive volume, maybe regain some share.
Precisely. Calculated moves, even if it hits the revenue per unit temporarily. Now, on to profitability. Adjusted operating profit was $711 million, down 18% in constant currency. And adjusted EPS hit $0.86, that 20% drop we mentioned.
And adjusted means they're taking out one-off things, right? So this is the core operational picture.
Exactly. It gives a clearer view of ongoing efficiency. And yeah, it shows significant pressure. Looking at margins, the adjusted gross margin was 34.2%, down 120 basis points. That's 1.2 percentage points. And the adjusted operating margin was 15.7%, down 210 basis points, or 2.1 percentage points. These pressures came from, well, higher input costs, ingredients, materials, and increased SG&A expenses, selling, general, and admin.
SG&A.
A chunk of that SG&A increase was actually proactive investments, particularly ahead of some big pushes in their pet segment.
So linking back to that investment year idea.
Precisely. Cash flow also took a hit. Operating cash flow dropped to $397 million from $624 million last year, mostly due to lower net earnings and, again, the yogurt divestitures.
Makes sense.
But on the capital allocation side, they were active. $110 million in capital expenditures, $331 million in dividends, and they bought back $500 million in shares.
Still returning cash to shareholders then.
Definitely. And notably, they used $1.8 billion from selling the yogurt business to pay down debt. So it shows a very deliberate reallocation of resources, strengthening the balance sheet, returning value even during a tough quarter, strategic use of funds.
That strategic reallocation makes sense, especially using the divestiture cash for debt. But like you said, a company this big, the picture's rarely uniform, is it? So what does this mean for the different parts of the General Mills empire? Let's unpack how these trends played out across their segments. Maybe start with North America retail.
Exactly. Because the story really does differ segment by segment. Let's start with North America retail, NAR. Biggest segment. Think Cheerios, Annie's, Pillsbury, all that. Net sales were $2.6 billion. That's down 13% reported, 5% organically.
13% is quite a drop. What drove that?
Well, the biggest chunk, 8 points, was those yogurt divestitures again.
Ah, okay.
Plus those price investments we talked about, and some timing issues with trade expenses, basically promotional spending with retailers. But here's a really crucial positive buried in there. They held or gained pound shares in 8 of their top 10 U.S. categories.
So even though sales dollars were down, they're holding their ground volume-wise in key areas.
Exactly. It indicates strong competitive positioning, despite the headline number. And get this, household penetration. The percentage of U.S. households buying their stuff actually grew for the first time in 3 years.
That's significant, reaching more homes.
Very significant. Still, operating profit for NAR was down 24%, showing the impact of those investments and costs.
Okay. What about North America Pet? They've put a lot of focus there.
Right. Pet sales were $610 million. That's up 6% reported, but actually down 5% organically. The difference. The Whitebridge acquisition added 11 points to reported sales. Shows the M&A impact.
So acquisitions helping the top line there. How's the core pet business doing?
It's mixed. Cat feeding and treats grew double digits, which is great. Real bright spot. But dog feeding, especially their Big Blue Buffalo Wilderness line, showed some weakness. Profit for pet was $113 million, down 5%. Again, higher input costs and that front-loaded SG&A for new launches.
What are those new launches?
They're pushing hard into growth areas. Love Made Fresh, their new fresh pet food, launched nationally. They expect it in 5,000 coolers by Q2. That's huge.
Wow, fresh pet food is a hot market.
Absolutely. And they're launching Edgard & Cooper in the U.S. as a super premium brand. Plus, Tiki Cat is growing double digits. So, strong focus on fresh and premium.
Got it. How about North America food service? Selling to restaurants, schools?
Foodservice sales were $517 million, down 4% reported, but actually up 1% organically. Strengths were cereal and biscuits. K-12 demand from schools was really robust.
Those seem reliable.
Yeah, quite stable. Headwinds were, again, yogurt divestitures and some flour pricing issues. Operating profit here was $71 million, basically flat year over year. Pretty resilient.
Okay, and international. You mentioned that earlier.
International was the clear standout, yeah. Net sales, $760 million, up 6% reported, 4% organically. Strong growth in India, North Asia, Europe. Haagen-Dazs stick bars were apparently a big hit in China and Europe.
Nice. Profitability there.
Huge jump. Operating profit hit $66 million compared to $21 million last year. That's up 196%.
Wow. Any caveats?
One small one. They noted about a 3% benefit from timing that's expected to reverse in Q2. So some of that profit might just be shifted from the next quarter. Still, very strong performance.
Good to keep in mind. And finally, the joint ventures.
Mixed bag there, too. CPW, their cereal venture with Nestle, saw sales down 2%. But Haagen-Dazs Japan was up 7%. So localized strength. Overall JV earnings, though, were only $7 million. Down 64%, mostly due to impairment charges.
Ouch.
Yeah. So, I mean, it really shows the diversity, doesn't it? Clear strengths like international, parts and pet, but then areas needing real focus like NAR and those JV impairments. It's complex.
That segment breakdown definitely paints a complex picture. So beyond the numbers and individual segment performance, what are the bigger strategic plays General Mills is making? You mentioned their remarkable experience framework and innovation earlier. What exactly are they doing there to try and regain that volume?
All right, this is where you see the strategy in action. That remarkable experience framework isn't just fluff. It's about investing across the board. The product itself, the packaging, how they talk about the brand being available everywhere online, in-store, you name it, and delivering value. It's holistic.
Trying to improve the whole consumer interaction.
Exactly. And on innovation, they've had some real wins recently. Things like Cheerios Protein, those Progresso Pitmaster soups, Mott's fruit-filled bars, apparently all exceeded expectations.
Cheerios Protein, I've seen that, tapping into health trends.
For sure. And the Progresso soups, trying new flavors, even marketing campaigns, like the Cinnamon Toast Crunch one, boosted social engagement by something like 500%. That shows they can still connect,
500% is impressive.
It is. In pet food, they're really leaning into that fresh refrigerated trend with Love Made Fresh. It's smart. Plays into how people treat their pets now.
The humanization trend.
Exactly. Plus, expanding super premium with Edgard & Cooper, Tiki Cat. They know people will pay for perceived, higher quality pet food. For food service, they're riding that K-12 momentum and making sure their cereals meet any new regulations.
Practical stuff.
And behind the scenes, efficiency is key. Their holistic margin management program is apparently delivering 5% savings on cost of goods sold. That's significant for the bottom line.
5% of COGS, yeah, that adds up.
And they're using tech. AI-driven forecasting is improving accuracy, cutting waste, and get this, saving over 50% of the forecasting team's time.
Wow. AI making a real difference there.
It seems so. It's not just tweaking things, it's optimizing the whole supply chain. That's a quiet but powerful advantage.
The AI forecasting does sound like a potential game changer. Okay, so with all these moving parts, the mixed results, these big strategic bets, what's the vibe from the executive team? What are Harmening and Bruce saying about navigating this investment year?
Well, their tone is, I'd say, cautiously optimistic. Yeah. The classic balancing act. CEO Jeff Harmening really hammered home that the priority is restoring that volume-driven organic growth, making brands more remarkable.
There's that word again.
Right. Focusing on value, innovation, marketing, visibility on shelves. CFO Kofi Bruce acknowledged Q1 was slightly ahead of their own internal expectations, but mainly due to some favorable phasing.
Meaning timing things, sales or costs hitting earlier than planned.
Exactly. So some benefits might have shifted into Q1 that were expected later. He warned those will unwind in Q2. But he expects the second half of the fiscal year to improve quite a bit.
Why the second half improvement?
A few reasons. Easier comparisons to last year's pricing. The benefit of that extra 53rd week in their fiscal calendar.
The extra week bump.
Right, an extra week of sales. Plus the impact of new innovations launching. So, yeah, they're acknowledging the near-term pressure on margins, but expressing confidence that these investments will start paying off later in the year and beyond.
Okay, let's try and boil this down for you listening. General Mills, huge company, lots going on. What were the real standout positives this quarter, and where are the persistent challenges or headwinds? It helps to see it laid out.
Definitely. On the positive side, that pound share growth in 8 out of 10 top U.S. categories is impressive. Shows resilience.
Like holding their ground.
Their innovation pipeline seems to be working, with new products doing well. The pet accelerators, cat food, treats, the fresh and premium push that looks promising.
Pet is key.
Absolutely. International growth was undeniably strong, especially Haagen-Dazs, Nature Valley. Foodservice showed good resilience, particularly K-12 and biscuits. And, crucially, that strong cost savings discipline, especially with the AI-boosted supply chain.
Okay, so some solid positives. What about the negatives?
Well, organic sales are still negative, despite the share gains. That's the big one they need to turn that volume trend around.
Still shrinking organically.
Yeah. Dog feeding, specifically Blue Buffalo Wilderness, lagging. That's a concern in a supposed growth area. North America retail, obviously weighed down by the yogurt sale and trade timing. Gross margins are still being squeezed by higher input costs. Operating cash flow took a big hit, down 36%.
That's substantial.
It is. And finally, those joint ventures, especially CPW, struggling with impairments, adds to the pressure. So, it really highlights the complexity of managing this huge portfolio in a tough market. Bright spots, yes, but also areas needing sustained work and investment.
Okay, so given all the good, the bad, the investments, what's the official word on their full-year guidance, and why is that second half of the fiscal year so critical for them to, prove their strategy is working?
You hit it right there. The second half is absolutely crucial for validating this investment year approach.
Yeah.
They did reaffirm their FY26 guidance, so still expecting organic net sales between -1% and +1%.
Basically flat.
Basically flat, yeah. Adjusted operating profit and adjusted EPS, both still projected down 10% to 15% for the full year. They do expect strong free cash flow conversion, 95% plus, showing that financial discipline.
Okay.
But the narrative is clear. The first half is pressured. Pricing resets, input inflation, those yogurt divestitures continuing to impact comparisons. The second half, though, that's where the turnaround is supposed to kick in.
From lapping tougher comparisons.
Exactly. Lapping comparisons helps, continued efficiency gains should contribute, and that extra 53rd week gives them a boost. It's really a bet on a strong finish to the year.
So if you're looking at this from an investment angle or just trying to figure out where a company like General Mills is headed long term, what are the key takeaways here? What should people really be watching?
Well, from an investment perspective, the main takeaway is that General Mills is intentionally in an investment-heavy year. They're accepting near-term profit hits to try and fix volume and market share. That's the strategy.
It's a choice.
It's a choice, not a surprise stumble. North America, retail and pet. They're mixed bags, right? Share gains and innovation, they're good signs. But the dog food softness and pricing resets are real drags.
Need to watch this closely.
Definitely. On the plus side, international and food service look like solid performers, offering some balance. And those cost efficiency programs, the AI, the holistic margin management, those are important long-term levers for margin recovery once this investment phase cools down.
So potential for future margin improvement there.
Exactly. So overall, management strategy seems credible. They seem to be executing on it, but patience is definitely required. Performance in the second half of fiscal 26. That is the key test. Can this volume focus actually translate into earnings momentum? That's what everyone will be watching.
So boiling it all down, what does this mean? General Mills is clearly making a big strategic shift, betting on innovation, market share, efficiency for the long haul. It's fascinating to see a major established player adapt like this, choosing investment now over maybe easier, shorter-term profits.
Yeah, and it raises that important question, doesn't it? How will these big investments play out against, shifting consumer habits? We've got private label pressure, ongoing economic uncertainty. Will this remarkable experience framework really deliver the volume growth they need? Will it truly revitalize those core brands? That's the big question mark going forward.
It certainly is. Well, thank you for joining us for this deep dive into General Mills' quarter. We hope you feel a bit more informed and ready to keep exploring this space. Just a reminder, we are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please be sure to consult a certified financial advisor.